Across the globe, the iconic vision of homeownership, a cornerstone of stability and prosperity, is increasingly slipping away for an entire generation. From sprawling urban centers to quiet suburban streets, reports indicate that buying a home has become an insurmountable challenge for many. For young professionals navigating the complexities of modern economies, the dream depicted in advertising and cultural narratives clashes sharply with the stark reality of the housing market. This isn't merely a local issue, it's a global phenomenon, with its roots deep within shifting financial landscapes and macroeconomic forces. For millennials and Gen Z, the ambition of owning property, a rite of passage for previous generations, now feels like a distant fantasy. Data from various economic institutes suggests a significant decline in homeownership rates among younger demographics compared to their parents at the same age. Analysts point to a widening chasm between income growth and housing costs. While wages have struggled to keep pace with inflation and the rising cost of living, property values in desirable areas have surged, creating an entry barrier that seems almost impenetrable. Reports from real estate analytics firms reveal a consistent, aggressive upward trajectory in housing prices across major global markets over the last decade. This surge has far outstripped average wage growth, making the financial hurdle of a down payment, let alone mortgage payments, increasingly difficult to clear. For instance, in many OECD countries, average housing prices have risen multiple times faster than median household incomes. This disparity transforms the act of buying a home from a long-term savings goal into an aspirational struggle, often requiring family assistance or a fundamental shift in life plans. As individual buyers struggle, a different class of purchaser has emerged as a dominant force in the housing market: institutional investors. These are not families seeking a home, but large corporations, hedge funds, and private equity firms viewing housing as an investment vehicle. Post-2008, a period of low interest rates and abundant capital created fertile ground for these entities to acquire vast portfolios of residential properties, particularly single-family homes. According to financial analysts, this shift has fundamentally altered market dynamics in numerous regions. Firms like BlackRock, through their various funds, and specialized companies such as Invitation Homes, have become major landlords, particularly in the single-family rental market. Reports from market intelligence groups indicate these entities often pay above asking price, leveraging their capital to outbid individual buyers. This strategy ensures a steady stream of rental income and asset appreciation. Critics argue that this financialization of housing transforms homes from essential shelter into commodities, distorting traditional supply-demand dynamics and making entry for individual buyers even harder. A critical factor enabling this institutional buying spree was the era of ultra-low interest rates following the 2008 financial crisis. Central banks implemented policies like quantitative easing, injecting liquidity into markets and making borrowing cheap. For large investors, this meant accessing capital at historically low costs, making real estate a highly attractive, relatively stable investment with predictable returns. Analysts suggest that these policies, while intended to stimulate economies, inadvertently fueled a massive transfer of housing stock from potential individual ownership to corporate portfolios. Beyond institutional investors, inflation has emerged as another formidable barrier to homeownership. Recent global supply chain disruptions, coupled with surging demand, have driven up the costs of building materials, from lumber to steel. Labor shortages in construction have also pushed wages higher, directly impacting new home prices. Economists from various institutions agree that these inflationary pressures mean that even if an individual can secure a mortgage, the underlying cost of the home itself has escalated dramatically, adding further strain to an already tight market. The impact of rising housing prices isn't confined to would-be buyers, it also reverberates through the rental market. As properties become more expensive to buy, both individual landlords and institutional owners pass these costs onto renters through increased rents. This creates a vicious cycle. Higher rents make it significantly harder for individuals to save for a down payment, perpetuating their renter status. Reports indicate that median rent increases in many major cities have consistently outpaced income growth, trapping a generation in an escalating cycle of housing unaffordability. This trend is often termed the financialization of housing, where residential property is increasingly viewed as a financial asset rather than primarily as shelter. Think tanks and policy analysts suggest that this redefinition encourages speculative investment, where housing is bought and sold based on its potential for financial return, rather than its utility for residents. This shift impacts not only affordability but also neighborhood stability, as corporate ownership can lead to less personal connection to communities and different approaches to property maintenance and tenant relations. While the impact of institutional investors is felt globally, its intensity varies. Research from urban studies departments indicates that these firms often target specific types of properties and neighborhoods, those with strong rental demand, good schools, and stable growth prospects. This often includes middle-income suburban areas, where they can quickly acquire multiple properties. This concentrated buying can rapidly deplete the available housing stock for individual buyers in these particular communities, further exacerbating local housing shortages and price inflation. The sheer scale of institutional investment is difficult for individual buyers to compete with. For example, in certain U.S. markets, institutional investors accounted for a significant percentage of home purchases in recent years, sometimes buying entire blocks of newly built homes or hundreds of properties in a single month. This volume purchasing gives them market power to dictate terms and outcompete individual offers, according to real estate economists. Their ability to deploy capital quickly and at scale reshapes the competitive landscape entirely. There is a vigorous debate among economists and housing experts about the precise role of institutional investors. Some argue they are primary drivers of price increases, actively bidding up costs and reducing supply. Others contend they are more a symptom of a deeper problem, capitalizing on existing housing shortages and a lack of new construction. They suggest that restrictive zoning laws, slow permitting processes, and NIMBYism, not in my backyard, opposition to development are the root causes, with investors merely filling a market void for rental properties. Regardless of the exact causation, the fundamental issue of housing supply remains critical. A report by the National Association of Realtors notes a chronic underbuilding of homes over the past 2 decades in many developed nations. This supply deficit, combined with population growth and increased demand, inherently creates upward pressure on prices. Institutional investors, in this view, simply exacerbate an already precarious situation by removing available units from the for-sale market, further tightening supply for individual homebuyers. In parallel to the crisis in affordable housing, many cities have seen a boom in luxury apartment complexes and high-end residential developments. These buildings, often dominating the city skyline, cater to a different segment of the market: affluent individuals or corporate clients. While visually impressive, their construction rarely alleviates the housing crunch for the average person. Urban planners and critics argue that this focus on high-margin luxury housing diverts resources and land that could otherwise be used for more accessible, mid-range housing options, further widening the affordability gap. The long-term consequences of this housing crisis for younger generations are profound. Without the ability to build equity through home ownership, a traditional path to wealth accumulation is blocked. This contributes to growing intergenerational wealth inequality, according to sociological studies. Furthermore, the constant struggle to afford housing can impact quality of life, family planning, and economic mobility. Experts warn that this creates a less stable society, where the financial future of millions remains precarious, regardless of their education or career paths. Addressing this multifaceted crisis requires a comprehensive approach. Policy proposals range from increased regulation on institutional investors to incentivize selling rather than renting, to direct government investment in affordable housing programs. Urban economists suggest that streamlining zoning and permitting processes, coupled with tax incentives for developers to build mid-range homes, could increase supply. The challenge lies in balancing market forces with social needs, ensuring that housing remains both an investment and a fundamental human right. No single solution will suffice, given the complexity. Crucially, there's a growing call for a fundamental shift in how housing is perceived. Activist groups and urban planners advocate for housing as a human right, moving away from its primary role as a financial asset. This paradigm shift could influence policy decisions, prioritizing permanent affordability and community stability over speculative gains. The conversation around housing is evolving, moving beyond simple supply and demand to encompass broader ethical and societal considerations, reflecting a growing urgency to reclaim the dream of stable housing for everyone. The global housing crisis, fueled by institutional investment and inflationary pressures, presents one of the defining challenges of our era. Its impact reverberates from individual aspirations to national economies. As sprawling city skylines continue to rise, the question remains, who are these homes truly for? Addressing this will require concerted effort, innovative policy, and a re-evaluation of housing's place in society. The path forward is complex, but the imperative to ensure stable, affordable housing for all remains undeniable. The future of a generation depends on it.